A stock drops 31% in 8 trading days, and everyone around you starts whispering the same 2 words: buying opportunity. SpaceX, ticker SPCX, hit $225 on the 16th of June 2026. 6 days later, it closed at $154. That is more than $600 billion in market value gone. And right now, as you're watching this, people you trust, financial creators, subreddit threads, your group chat are telling you the same thing. This is the dip, buy it. And I'm here to tell you that sentence, buy the dip, is one of the most expensive sentences in the English language because it sounds like math, but it is actually a feeling. And on this channel, we don't trade on feelings. We run the number. So here's what I want to do today. I want to give you one concept, one single idea that will tell you whether any dip on any stock is actually a deal or a trap. I call it the distance to the floor. And by the time this video is over, you will be able to run it yourself on SpaceX, on any IPO, on anything anyone ever tells you is on sale. The distance to the floor is the only number that matters when a stock is crashing, and almost nobody talks about it. Let me show you why. But first, let me be honest with you about something because I think it matters. This is not a video about SpaceX being a bad company. I want to say that clearly. SpaceX is arguably the most impressive engineering company on the planet right now. Starlink has over 10 million subscribers. It generated $11.4 billion in revenue last year and $4.4 billion in operating profit. The Falcon 9 is the most reliable orbital rocket ever built. The Starship program is genuinely pushing the boundary of what humanity can do in space. I am not here to mock that. Nobody serious is. What I am here to do is separate the company from the stock, because those are two completely different things. A company can be extraordinary, and its stock can still be a terrible buy at the wrong price. In fact, that's exactly how the most painful losses in market history happen, not when people buy bad companies, but when they overpay for great ones. And SpaceX right now is the most dramatic case of that separation I have ever seen in a public market. So let's talk about the distance to the floor. Here's the idea in its simplest form. When a stock crashes, the first question most people ask is, how far has it fallen? That's the wrong question. The right question is, how far is it from where it should be? That's the distance to the floor. Think of it like this. You're standing on a ledge, you slip and drop 10 feet. Scary. But the question that determines whether you're okay isn't, how far did I just fall? The question is, how far is the ground? If you're on the second floor, you drop 10 feet and you're basically at the bottom. Dust yourself off. But if you're on the 90th floor, you just dropped 10 feet and you have 800 more feet of air beneath you. Same drop, completely different situation. And the only difference is the distance to the floor. That is exactly what is happening with SpaceX right now. The stock dropped 31% from its peak. People see that number and their brain says, that's a lot. It must be close to the bottom. But they haven't asked where the bottom actually is. So let me show you. Let's start with the most basic version of this math. SpaceX, the company, generated $18.7 billion in revenue last year. It lost $4.9 billion. Not earned, lost. Now, when the stock peaked at $225 a share, the company had a market capitalization of roughly $2.9 trillion. Run the number on that. 2.9 trillion divided by 18.7 billion in revenue, that is a price to sales ratio of over 150. Let me put that in context. NVIDIA, the single most dominant company in AI chips, growing revenue at 85% a year, printing $45 billion in quarterly profit trades at roughly 13 times sales. Apple, the most valuable company in the world, trades at about 9 times sales. The S&P 500 as a whole trades at around 3.7 times sales. SpaceX, at its peak, was trading at over 150 times sales on a company that lost money. Now here's where the distance to the floor comes in. The stock has crashed 31%. It's now around $156. So let's run the number again. At $156 a share, SpaceX's market cap is roughly $2 trillion. $2 trillion divided by 18.7 billion in revenue. That's a price-to-sales ratio of about 107, so the crash brought the ratio down from 150 to 107. Sit with that for a second. A 31% crash only closed about 30% of the gap between absurd and slightly less absurd. Now, where's the floor? That's the real question. Morningstar, one of the most respected independent research firms in the world, published a fair value estimate for SpaceX of $62 per share. $62. The stock is currently at $156. That means even after one of the most dramatic crashes in recent IPO history, SpaceX would need to fall another 60% just to reach what one credible analyst considers fair value. The distance to the floor is not small, it's enormous. And the 31% drop you just saw, that didn't get you to the floor. It barely got you past the ledge. Let me show you another way to see this, because I want the math to really land. Let's say you're a reasonable person. You don't need SpaceX to be cheap. You just want it to trade at a valuation that's in the same universe as other high-growth tech companies. Let's be extremely generous and say SpaceX deserves to trade at 30 times revenue. That would make it more expensive than almost every mega-cap tech stock on Earth. 30 times 18.7 billion is 561 billion. That's the market cap. Divide by roughly 13 billion shares outstanding and you get a stock price of about $43 a share. That's the price if SpaceX were valued the way we value extremely expensive high-growth technology companies. The stock is at $156. The distance to the floor, even using a generous floor, is 72%. You're not buying a dip. You're buying a stock that could fall another 72% and still not be cheap. And here's the part that makes this dangerous, the part most people get wrong. Let me show you the recovery math, because this is where buying the dip goes from optimistic to mathematically brutal. Most people hear the stock dropped 25% and they think, okay, I just need a 25% bounce to get back to even. That feels intuitive. It's also wrong. Let me walk it step by step. You buy a stock at $200. It drops 25%. That's a $50 loss. So now it's at $150. To get back to $200, you need a $50 gain. But $50 on a $150 base is not 25%. It's 33%. You need a 33% gain just to recover from a 25% loss. Read that again slowly. Now scale it up. SpaceX peaked at $225 and is now at $156. That's a 31% drop. To get back to $225, you don't need a 31% gain. You need a 44% gain. At $156, a 44% move is another $69 per share. The stock has to climb almost $70 just to get you back to zero. Not profit zero. And it gets worse the further it falls. If SpaceX drops 50% from the peak down to about $113, you'd need a 100% gain to break even. The stock would literally have to double. If it drops 75% to around $56, you need a 300% gain. It has to quadruple. This is the brutal asymmetry of losses. Going down is fast. Climbing back up is exponentially harder. And every dollar you invest in a falling stock starts at a mathematical disadvantage that gets steeper with every tick down. So when someone says, buy the dip, what they're really saying is, I believe this stock will not only stop falling, but will rally 30, 40, 50% or more just to get me back to where it was last week. On a stock that lost $5 billion last year, that is not a strategy. That's a prayer. Now let me be honest about the catch, because this is a math channel, not a doom channel. Couldn't SpaceX grow into its valuation? Couldn't revenue triple or quadruple and make today's price look reasonable in hindsight? Yes, that's the bull case, and I want to state it fairly, because it's not crazy. Starlink is a real business generating real profit in a market with enormous global demand. The launch business has structural advantages no competitor can match right now. And the XAI division, for all its current losses, sits on infrastructure that could become enormously valuable. But here's the thing about the bull case. It requires near-perfect execution over many years, and it requires you to believe the market has correctly priced in all of that future growth today. At 100+ times revenue on a company that just went public 12 days ago. That is an enormous amount of faith, and faith is not math. Nobody, including me, can tell you where SpaceX stock will be in 5 years. What I can tell you is where it is right now relative to what the company actually earns, and that number is, by any historical standard, extreme. Let me also tell you about something coming down the road that most people buying this dip haven't thought about. It's called the lockup expiration, and it is a supply cliff. Right now, roughly 95% of SpaceX shares are locked up. They cannot be sold. Only about 4 to 5% of shares are actually available to trade on the open market. That tiny supply is part of why the stock exploded so fast after the IPO when everyone wants to buy and almost nothing is for sale. Prices go vertical, but that same mechanism works in reverse. And the locks are about to start opening. The first selling window opens around late July to August, after SpaceX reports its first earnings. Around 7% of outstanding shares become eligible to sell. Then the standard 180-day lockup expires in December 2026. That's a much larger wave. And Elon Musk's own shares, roughly 6.4 billion of them, stay locked until June 2027. Each one of these dates is a dam holding back supply. When those dams open, the available supply of shares doesn't just increase, it multiplies. And more supply, all else equal, means lower prices. This is not speculation, this is market mechanics, and it's happened before. Which brings me to Rivian, because if you want to see what happens when a company built on hype, priced on dreams, and bought by retail investors meets the distance to the floor, Rivian is the cautionary tale. Rivian went public on the 10th of November 2021 at $78 a share. On its first trading day, it closed at just over $100. Within a week, the stock hit $172. Rivian was briefly worth more than General Motors, more than Ford. A company that had delivered fewer than 1,000 vehicles was valued at over $150 billion. The hype was real. The cars were real, people loved them. The Amazon delivery van contract was real, and none of it mattered, because the stock wasn't priced on what Rivian was. It was priced on what people hoped it would become. Then the slide started. In the first few weeks, Rivian dropped about 20% from its peak. And you know what happened? People bought the dip. Millions of retail investors saw a stock that had been $172 trading at $135 and thought, this is my chance to own the next Tesla at a discount. Let me show you how that worked out. Rivian didn't stop at a 20% drop. It fell to $100, then $78 its IPO price, then $50, then $30, then $22, then eventually below $9. From the peak of $172 to the trough, Rivian lost 95% of its value. If you bought the initial 20% dip at $135, you eventually watched your investment lose 93%. If you invested $10,000 buying that dip, you were left with about $700. The dip wasn't a dip. It was the first inch of a 95% waterfall. And the people who bought the opportunity weren't catching a deal, they were catching a falling knife. And here is the thing I need you to understand. Rivian didn't fail. The company is still alive. It's still making cars. It recently started delivering its R2 SUV. Its products actually got better. What failed was the price. The stock was priced for a future that would take a decade to build, and the market decided it didn't want to wait. The distance between where the stock was and where the fundamentals justified it being the distance to the floor was enormous. And the dip buyers were standing at the top of the building, thinking they were near the bottom. Does this sound familiar? Let me draw the parallel directly, because I think the numbers are striking. SpaceX IPO'd at $135. Rivian IPO'd at $78. SpaceX surged 67% to $225 in 4 days. Rivian surged 120% to $172 in 6 days. Both were the most hyped IPO of their respective years. Both were real companies with real technology, both were priced on dreams, not earnings, and both began falling shortly after the initial euphoria. Now, I am not saying SpaceX will follow the exact same path as Rivian. SpaceX is a fundamentally stronger company with more revenue, more profit in its core business, and a wider competitive moat. That is an important difference, and I don't want to erase it. But the pattern of what happens when a hype-priced stock starts correcting is the same. And the math of loss recovery doesn't care how good the company is. It only cares about the gap between price and value. Let me give you the number one more time to make sure it's clear. SpaceX at $156, revenue of $18.7 billion, growing at about 33% a year. Net loss of $4.9 billion. Price to sales ratio of over 100. Morningstar fair value estimate of $62. The distance to the floor is somewhere between 60 and 75% below where the stock trades today, depending on which set of assumptions you use. A 31% crash, as dramatic as it feels, has covered maybe a quarter of that distance. Maybe. You are not buying near the bottom. You are buying near the top of what may be a very long staircase down. Now, let me tell you what I'd actually do, because I don't think the answer is to ignore SpaceX forever. That's the other loud voice in this conversation, the people who say it's all a scam, it's all hype, walk away. I don't agree with that either. SpaceX has real assets and real revenue and a real chance of becoming one of the most important companies of the next decade. The question isn't whether SpaceX is a good company. The question is whether this price, today, gives you a reasonable chance of making money without taking on extraordinary risk. And the honest answer is, not yet. If you believe in the long-term story, here is the patient approach. Wait. Let the lockup expirations pass. Let the first few earnings reports come in. Let the market figure out what SpaceX actually earns, not what people hope it will earn. Let the supply of shares normalize so the price reflects fundamentals rather than a 4% float being chased by millions of retail traders. Waiting is not the same as missing out. Waiting is the thing that keeps your money alive long enough to invest it when the distance to the floor is small instead of massive. And if you want a rule of thumb, something you can carry with you beyond this video, here it is. Before you buy any dip in any stock, ask one question. Not, how far has it fallen? Ask, what is the distance to the floor? Figure out what the company actually earns. Figure out what a reasonable valuation multiple would be. Multiply those two numbers. Compare that to the current price. If the gap between where the stock is and where the fundamentals say it should be is still enormous, then what you're looking at is not a dip, it's a falling knife. And the only smart move with a falling knife is the same as it's always been. You don't try to catch it midair, you step back, you wait for it to hit the ground, you wait for it to stop bouncing, and then only then you pick it up. The distance to the floor, run it on SpaceX. Run it on the next hot IPO someone tells you is on sale. Run it on anything. Because the math doesn't lie, and the math doesn't care about hype. It just tells you how far you have left to fall. If this is the way you want to think about your money math first, hype, never subscribe. That's the whole point of this channel. We do the arithmetic so you don't have to take anyone's word for it. I'll see you in the next